Okay, so on Monday, you'll never guess what just landed. Well, a paper from the Institute of Physical Studies, and it has a huge suggestion that could impact your retirement. So I thought this needs to be a video, and it's called A Blueprint for Better Tax Treatment of Pensions. Sounds great. And yes, right in their sights, tax-free cash. And it's a corker of a paper. So in this video, I'll be telling you about the pros and cons of whether you should be worried about this thing that's just come out, a background on where some of these ideas may have come from, and of course my personal opinion on this. In fact, it sometimes kind of veers into a rant. So I'll also be talking about what I make of it, the headlines it generates, and what that means for everyday people. And the key thing I think you need to be aware of when reading stuff like this in the press. Anyway, so there's a link in the paper in the description below if you'd like to find out yourself. So first, I just need to give a bit of a background to make sure we're all on the same page. With a pension, the general rule is you get tax relief for personal contributions. And there are lots of caveats here I won't go into. But if it's a money purchase fund where you have a pot that's invested, you get investments that grow free of capital gains and income tax. Then currently, from normal minimum pension age, now 55, but it's going up to age 57, you can usually take up to 25% of the amount built up in that pension as a tax-free lump sum. So super simply, if your pension's worth 60 grand, you get £15,000 tax-free of that, and the rest, the 45 grand, is taxable at your marginal rate when you draw it. There is also though what's called the lifetime allowance, which is the ceiling limit for pension benefits that you can build up with, and the current lifetime allowance is 1,073,100. So just to explain this very briefly, because I didn't do this very well in the recording, the maximum tax-free cash you can receive is 25% of either your lifetime allowance or the lifetime allowance remaining. So basically what that means is the maximum tax-free cash you can have under the current lifetime allowance is £268,275. Anyway, what I've just said is kind of my opening gambit for how ridiculous this entire situation is. Even for something as simple as me saying you can get 25% of your pension withdrawal tax-free cash, it took me about 30 seconds to throw in a ton of caveats because our pension system is a mess. Anyway, with that in mind, the spreadsheet boffins at the IFS thought it would be a great idea to come up with some more angles to spread confusion and uncertainty. So let's hear what they have to say. So the first bit that they go over is the tax framework, and on this paper they go into explain a bit of a background of the general tax position. So firstly, kind of any savings vehicle involves three main flows of funds which might be subject to tax. So let me explain. You've kind of got the contributions you make, the returns that get accrued, and then your withdrawals. And you could get technically taxed at different stages. So let's give you an example. Let's say you've got money in a bank account. Well, that's come from generally after-tax income. You know, you paid tax to put that money into a bank account, and it gets interest, which is also potentially taxable, even though there are some allowances, but put that aside for now. And then you can withdraw, but the money you take out isn't taxable because you've already paid tax to get it there. Anyway, they abbreviate when that happens as to taxed, exempt. Anyway, there are a ton of exceptions to this kind of setup. So if maybe you've got gifted money or inherited money, or maybe the money you've received has been in your personal allowance. But we're just talking general frameworks to get the idea of a structure. But pensions are different. Their income tax is close to one where the contributions are made pre-tax because individual contributions are tax relievable. The returns are untaxed, and then the withdrawals are subject to tax. This is known as exempt, taxed. Anyway, what the paper says is where an individual's tax rate does not vary over time, there is no real difference in the overall generosity of this exempt tax system. It then goes on to say that these systems vary overall in their generosity, though, when individuals have different starting points in their life. Yeah, obviously stating the obvious. So basically, the implication here is that as people can pay more tax when they are working than less when they retire, that is perhaps unfair on those who don't get that variability as far as different tax statuses of their life. Here are the main suggestions they put forward. They firstly suggest that upfront tax relief should remain, and I agree with that, and even suggested a 30% all-in tax relief for everyone instead of the different taxable rates. Now, for what it's worth, I personally don't have a problem with that suggestion. So instead of basic rate getting 20%, higher 40, and additional 45, this would help uplift those who don't have potentially the benefit of higher rate at some point in their retirement and still incentivises savings in probably even a simplistic way. So I don't have a problem with that. It is important to say here that HMRC statistics show that in 2020-21, 52% of upfront income tax relief was given to higher rate and 6% additional rate, whereas only 13% of the income tax payers were higher rate taxpayers and just 1.4% were additional rate taxpayers. So it sounds unfair, right? Well, look, hold on, because later in the report it also stipulates if one is going to have any system for tax relief for savings, then it's always going to be the case that the higher earners will gain the most. After all, they pay far more tax. 73% of income tax is paid by higher and additional rate taxpayers, much more than the proportion of pension tax relief that they benefit from. Okay, so we kind of talked around the houses there a bit about the system potentially being unfair, but then we've also turned around and said, well, actually, the higher earners get the higher rate tax relief because they pay more in tax. So we're keeping tax relief, but here are the big 3 suggestions. Here's the big one. The 25% tax-free cash component needs reform, aka get rid of some of the tax-free cash. They said that should happen as it currently provides an additional tax subsidy to those who have already accumulated big pensions and provides a more generous rate of subsidy for those who are higher rate taxpayers in retirement than those who are basic rate taxpayers, and is little or no value at all for those on the lowest income, non-taxpayers. They say at the very least it should be capped so it only applies to 25% of, say, the first £400,000 accumulated pension fund. They then go on to explain a pretty convoluted way to neutralise this for basic rate taxpayers by applying a 6.25% taxable top-ups on all pension withdrawals. You chose to work in pensions, you chose to work in pensions, you chose to work in pensions. They also then go on to say the bit which I think might make your eyes glaze over, which is national insurance treatment of employer pension contributions should be ended. We should propose that an all individual pension contribution should receive upfront relief equivalent to the rate of employee national insurance contributions. And also they recommend applying employer national insurance contributions to all employer pension contributions alongside a new subsidy on all employer pension contributions. But the 2 and 3 are basically just to make some of the pension planning options available right now less attractive. They've then put in a lovely graph showing the tax savings over time. There is also a suggestion that the changes could be made in combination with adjusting the lifetime limits, like the annual allowance or the lifetime allowance, to make things more generous. And at that point, I threw up over this pointless waste of space document. And look, I'm being facetious here, but honestly, give me strength. We're going to make things simpler by making them more complicated. But anyway, before I go further, for my sanity, please do consider subscribing to the channel. I've got a ton of videos which are less ranty on personal finance, pension planning, and making the most of your money, and it would be great to have you on the journey. Okay, I think we've kind of had enough of this now, haven't we? Let me just talk honestly, sort of me to you. Now, no one needs more complexity around pensions. They are a nightmare with all the existing caveats I have to throw in at the best of times. In fact, the problem when things like this happen, as far as big, endless tweaks to the pension system, is that all that happens, in my view, is the voice that might be in the back of your mind, but it's certainly the one that I regularly see on comments in my other videos. And this voice really loudly basically says, I don't trust pensions, I think they'll change the rules. And all, this useless, probably well-meaning paper does reinforce is the viewpoint that I think is not only incorrect, but does real damage to people's future. It also completely misses the bigger and more important picture. We as a nation simply are not saving enough for retirement at the moment. While auto-enrolment has been a huge success, with 8 out of 10 employees now being part of the scheme, in the UK, our retirement savings are currently inadequate to meet the needs of most retired people in this country. Some people are well provided for, but many aren't. And this problem is only set to get worse over the next 20 years. Auto-enrolment has been hugely positive, but it's a long way off having a meaningful impact on later life income, especially if the lower income thresholds and low contributions that are currently in place are maintained. And look, while these proposals might be very well-meaning in reducing that inequality gap, which I strongly support, I really strongly feel that these changes, especially around the tax-free cash element, will be a huge own goal because it's seen as one of the main perks of a pension, and it will only reinforce the sadly more common than it should be view of I can't trust pensions because they'll change the rules, instead of what it should be, which is pensions, great for saving, I need to do more. The bigger and wider context here we've got to be aware of is that the effect for new generations is not having access to defined benefit pensions like the previous generation. We don't know what the expected position is for asset returns going forward. So useless sort of pen pushing for a generation who not only need growth on their pension, but also have less and less security of income in retirement, I personally think is not helpful. And if I take the research from the excellent Langcat and their report from 2021, Home Truths, they show projected weekly retirement income for men and women in 2021 based on weekly earnings. And as you can see, it's dropping for men, but it's maintaining flat for women. Now, the gender gap is thankfully starting to close over the next 20 years, but this is actually stated as largely down to declining male income levels of defined benefit pensions that are falling away. Anyway, the trend is projected to continue all the way up to 2045, which means that pensions at that point will be about £200 per week for women and about £230 per week for men. But what's even more concerning is that when we map that against the Pension and Lifetime Savings Association, we can see that these projections, judged against the 2021 figures, for a couple there's a £4,000 shortfall from achieving a moderate living standard in retirement, and shockingly an £8,000 shortfall for a single person on average. In fact, the single person's projection, based on all of this, shows that on average they're only £1,900 per year just above the minimum standard. And before you think any of these sort of standards are great quality of life, living the dream, they're really not. Current figures are £127 per week for food for a couple, including food away from home as well. Maybe once a year, a 2-week holiday in Europe and a long weekend in England. Not extravagant. And if we add this kind of projection together, it shows that 12.5 million people retired in the UK. There was an aggregate and annual shortfall in retirement income of about £48.4 billion per year. And on the face of it, this paper, probably well-meaning, which says, look, other desirable features of a pension tax system include simplicity and stability over time, as both should help individuals to respond to incentives provided and plan properly for the long term. And it doesn't seem to recognise that by adding complex rules and changing the big features of one of the best parts, apparently for many people, about pensions, it just builds further mistrust. It also states in relation to the generational unfairness in wealth. Given this in the context of remarkably where pension incomes are now, on average in line with those working age population, there is surely a case for any reductions in generosity to apply, at least partly, to all generations. So again, I don't get that. We should reduce the generosity for pensions for everyone so that the young people have a less generous pension system, because that will help even things out. Look, in my view, whatever their intentions, they're so focused on trying to close the wealth gap, they are blind to the consequences of the real issue, which is the savings gap. And while, look, I do acknowledge there are a few proposals in here which could even be good ideas, but there's also bits in here which just seem way off the mark. Like, for example, someone with an annuity is more deserving of tax relief than someone who's making a withdrawal on a flexible basis. So the main conclusion that matters, should you be worried about this? What do you need to do? And honestly, my thoughts is I think we just need to keep some perspective here and remember a few things. And remember, one, look, anything I've said here is just my opinion. It's my channel. I can kind of say what I want. But what are you going to do, IFS? Spreadsheet me to death. Anyway, number two. This is a policy paper written by academics who've got their own reasons for writing them. This is not government policy, and currently there's no indication that it will become government policy. 3. Even if this was to become government policy, there is good precedent for transitional rules with any changes. In fact, with lifetime allowance and annual allowance, they in general have always been transitional rules put in place. Not always, in general. Next, I am not convinced this would be a vote winner, which may, for some reason, be on the minds of some politicians right now. And like the detail we saw in the press about an ISA cap, it might just be wild suggestions. So just bear that in mind before betting this would happen. Most importantly though, we need to not let this stuff distract us from our long-term goals and making good financial decisions. As tempting as it is, in my view, this is kind of like government policy research paper version of meme stocks. Tempting to get drawn in, might get an emotional kick out of it, not helpful in the long term. Pensions do remain one of the very best, most tax-efficient ways to save for your retirement, and chances are you need to do more of it. But hey, why don't you tell me in the comments, do you think they'll come after your tax-free cash or not? So anyway, if you did find this video useful, then I have another one for you, which is aged like a fine wine. 5 reasons you shouldn't take your tax-free cash. See you next time.